In this week's video, we'll cover a stock market signal that's only been flashed 4 times in the last 70 years. We've got a lot to cover this week, so we'll be moving quickly. Once again, we'll be testing the hypothesis as we cover the new data and new studies and new charts. We'll be asking ourselves, does it align with or contradict all of the bullish evidence that we've been covering since April 6th, including the concept that we covered on May 8th, that history says the low may be in and stocks may continue to rally. Left side of the screen, Twitter handle where my cursor is, posed the following question. Is anyone positioned for a 5 to 10 year economic expansion? The tweet had this table shown on the right as the last 5 U.S. recessions and subsequent economic expansions. Another good question to ask ourselves as we walk through this week's data. Does it appear as if market participants are starting to prepare for the next economic expansion that could last years? This is a weekly chart. The top portion of the chart shows the dividend yield for the S&P 500. The bottom portion of the chart shows the 19-week rate of change. It's been 19 weeks since the S&P 500 bottomed on March 23rd. Chart goes back to 1950. We just hit the blue line in the present day. We hit it in 2009, 1982, and 1975. Since these are the only other periods looking back 70 years, it might be logical to ask and answer. What happened next in the stock market? If you know your market history, you know all 3 of the previous signals occurred after a major market low. Also might be helpful to ask and answer. Specifically, walking forward from the date of the signal, which is very, very similar to early August of 2020, how did the S&P 500 perform? The answer is extremely well. All 3 cases higher 2 weeks later, 1 month later, 6 weeks later, 2 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. The average gain looking out 1 year from the date of the signal, 14.2%. Once again, in the present day, we have something that we can see, measure, and put in a model. Something that just happened that tells us to keep an open mind about much better than expected outcomes in the stock market over the next 1 to 5 years. And while there's a lot of green in this table, there's not a lot of progress in the market in this area here, reminding us, even under bullish circumstances, it's extremely important to have realistic expectations about 100% normal and to be expected volatility. So this is the historical message based on the recent shift in the S&P 500's dividend yield. Is there anything else that delivers a similar message in the present day? The answer is yes. Chart dated August 5th of 2020. NYSE Composite Weekly going back to 1964, 1965. On August 5th, we were between 18 and 19 weeks from the low that occurred on March 23rd. And once again, we have a very, very rare shift. This move here going up to the blue line only occurred 3 previous times, 2009, 1982, and 1975. And specifically, we hit the blue line on July 24th of this year, July 10th of 2009, November 5th of 1982, and May 2nd of 1975. Thus, July 24th of 2020 is similar to the 3 dates shown in blue on your screen. How did the S&P 500 perform walking forward from the blue dates? The answer is extremely well. In this case, the gain was 57% into 1980, over 100% into 1987, and from the date of the signal in 2009 to the recent peak in 2020, the S&P 500 tacked on an additional 285%. Since the model uses a weight of the evidence approach, is there anything else? Yes, now we're looking at market breadth. NYSE stocks, the percent greater than their 200-day moving average. I have data here going back to 2002. In this case, it's a daily chart. August 5th was 94 trading days from the March 23rd low. You can see the rate of change, which is indicative of a breadth thrust. Only 5 previous times have we seen a rate of change hit this line, the red horizontal line shown where my cursor is. 2019, 2016, 2012, 2009, and 2003. And if you know your market history, you know in each case, if we walked forward in the S&P 500 to the right of the vertical red line, good things happened. And in some cases, for a long period of time. The rate of change move is similar, as well as the move in the indicator. Very, very rare to get down here and get back to here. We just did it in the present day. Chart dated August 5th of 2020. This is a daily version of the chart. Looking at the same indicator, but using a monthly rate of change, we've only seen a spike like this one other time, May of 2009. And as we know, walking forward from May of 2009, if you were invested in the S&P 500, you experienced extremely satisfying longer-term returns. Staying with the weight of the evidence theme, Value Line Geometric Index is a daily chart. It's dated August 5th of 2020. Similar concepts here. 94-day rate of change. Helps us understand the shift in market participants' perceptions about future economic outcomes. This is a rapid shift. This is a rapid shift. This is a rapid shift. Rate of change has only tagged the upper blue line 2 previous times. And in both cases, good things happened walking forward. In 1982, for the average stock, similar situation walking forward in the Value Line Geometric Index, an extremely broad index from 2009. Should be noted, a lot of volatility between point A and point B, a lot of volatility between point A and point B. Top portion of your screen is the NYSE Advanced Decline Volume line. Bottom portion is the S&P 500. The 100-week moving average for the breadth indicator is shown in green. In the present day, we dropped below the 100-week moving average, and we are currently trying to retake it, which is similar to the 4 previous periods denoted by the yellow arrows. It's noteworthy. Those 4 arrows show up in 2009, 2011, 2016, and 2018. And if you know your market history, walking forward from this point here, for the most part, from a longer-term perspective, good things happened in the stock market. Everything that we've covered thus far, none of it predicts anything. It simply helps us assess the probability of good things happening relative to the probability of bad things happening. This is a weekly chart of the Dow Jones World Industrials Index. Mark this chart up earlier in the year. Noteworthy that price has climbed back above all of these potential obstacles, including trading back above an upward sloping 200-week moving average shown in red. This is a daily chart of bonds versus stocks. Top portion of your screen. Have data going back to 1986. 94-day rate of change here. 94 trading days since the low on March 23rd. S&P 500 shown on the bottom panel. Only 2 previous times in the last 34 years have we seen a move from the upper blue line to the lower blue line. One of them occurred in August of 2020, so basically in the present day. The only other time we've seen a similar move, 2009. Thus, this point here in August of 2020, rate of change is similar to this point here. If we walked forward in the stock market from this point here, really good things happen for a long period of time. All things being equal, we would prefer to see the NYSE advanced decline line making new highs. Doesn't really guarantee us anything about the future, but we would prefer to see a bullish divergence like this. This has exceeded this high. The S&P 500 on August 5th had not exceeded this high. While that doesn't guarantee us anything about what next week or the next 3 months will look like, we would prefer to see that relative to a bearish divergence. It's also typically a good sign from a trend perspective when the breadth indicator can break out, as it did in 2020. CCM market model tracks a wide range of evidence. These are simply notes. It's a noisy looking chart. Takeaway is very, very simple. After the market bottomed here, we wanted to see if this indicator could get back into the green box. How might that be helpful? Q4 of 2008, S&P 500, where my cursor is, the market takes another significant leg down. Notice here, this is Q4 of 2008. We never get back into the green box. We get back into the green box in Q1 and Q2 of 2009. Here's the look of the indicator in the green box in calendar year 2009. Here's the look of the indicator on July 31st of 2020. Notice where the indicator is here during a bullish trend. Notice where it spends most of its time during a bullish trend, most of its time during a bullish trend. In the early stages of a new trend, this type of data, this is from Thursday's session, tends to be mixed. It's a good sign when you start to get unbalanced data, as we've seen in recent weeks. Similar concepts here, just looking at it a little bit different way. It's a weekly indicator showing the percentage of NYSE stocks that are making a new 52-week high. Relatively rare to get way down here and make it back to the upper blue line. We just did it in the present day. This chart is dated July 31st of 2020. Looking back to 2009, it occurred 4 previous times, and in each case, good things happened in the stock market. This point here is similar to this point here. This is how the stock market performed. The same can be said for this point, and this point. You can pause your video player and look at this chart in more detail. Basic takeaway, NYSE Technical Index weekly. When you get down to the lower Bollinger Band here and then can retake the center line and get back near the upper Bollinger Band, typically that's good for the market. Happened here in 2009, here in 2011, here in 2012, here in 2014, 2016, and 2019. We classify this as anecdotal evidence, but the present day look right here is a lot better than the look here in calendar year 2008 during the height of the financial crisis. Continuing with a weight of the evidence approach, breadth indicator shows the percentage of NASDAQ stocks greater than their 200-day exponential moving average. Once again, pretty rare to make it from the lower blue line. This is extremely oversold. This is a breadth thrust back to the upper blue line. Extremely oversold. This is a breadth thrust back to the upper blue line. And the rate of change, the 94-day rate of change, we have data going back to 2002. There's only 2 periods that are even remotely similar, the present day and 2009. And we hit the green line in the second half of 2009 after the major low in the S&P 500. Same concepts, NYSE stocks greater than their 200-day exponential moving average. Only 3 times in the last 34 years have we seen a move like this and a move like this, 2020, 2009, and 1988. History tells us that's good company if you're a long-term investor. Lower portion of the screen is the S&P 500 index. Remember, we can look at data from 2 perspectives. We have something in the present day that looks like the early stages of a bullish period. We can also learn something by comparing the present day to major tops in the S&P 500. Here's the S&P 500 here. This is the topping process, 1999, 2001. This is the dot-com bust bear market. This is the major top here before the financial crisis bear market. Look where the indicator rate of change is in the present day. It's near the green line. Do you see the rate of change anywhere near the green line before this major top? The answer is absolutely positively no. Same question near the top in 2009. The answer is the same. This really doesn't look anything like this. And we can make the same argument when we look at NASDAQ stocks greater than their 50-day exponential moving average. This is the S&P 500 here. This is a major top in the stock market here, October of 2008. This is the financial crisis bear market. It's a waterfall plunge here, 2015, and we make a lower low in the S&P in early 2016. Might be helpful to know, is this a last gasp look here? Do we have anything like this before the market plunged here and here? Here's the level of the indicator in the present day. We recently moved from here to here. Here's the exact same level before the S&P 500 plunged in 2015. Indicator nowhere to be found. Breath is much, much worse before this plunge. Same thing here. This is the recent reading. Look at all this white space here. Before the S&P 500 peaked in 2007, this indicator was nowhere near the levels that we've seen in the present day, nor did we see a thrust like this. And we know that a thrust like this, moving from the lower blue line to this green box, lower blue line to the green box, lower blue line to the green box, lower blue line to the green box. Notice this happens after the major low. It doesn't happen before the major peak. This happens after the low in 2016. And this happens after the major low that occurs in October of 2002. So the present day does look very, very similar to bullish periods. And it really doesn't look anything like periods before the stock market plunged. Do we have anything else that tells us that some market participants may already be positioned for a multiple-year economic expansion? Let's see what we can learn looking at a monthly chart of the S&P 500 dated August 6th of 2020. This is monthly MACD on the bottom of the screen. It helps us with longer-term stock market momentum. This is the S&P 500 in black. This is the almost 31% plunge that occurred in 2020. Get a bearish monthly MACD cross that goes into the history books. If we walk forward to August 6th, we all know the S&P 500 had a strong rally off of the March low. And at the end of July, a bullish MACD cross, monthly MACD cross for the S&P 500 went into the history books. Therefore, it might be helpful to ask and answer. How many times in the last 70 years has something similar happened? Similar being a big plunge in the S&P 500, a bearish cross, followed by a bullish cross. 14 previous times dating back to 1950. What happened walking forward in the S&P 500? Really, really good things over the next 2 years for the most part. Looking out 2 years from the date of the signal, which would be very, very similar to walking forward historically 2 years from July 31st of 2020. That is the day that this signal went into the history books. Notice every single one of these historical dates appears at the end of the month. Average gain 2 years later from the date of the signal, 21.32%. Median gain, 21.39%. Worst case scenario, 7.39% 2 years later. Best case scenario, 36.16%. Once again, we have hard data, something that just happened in the present day that tells us We can try to take a longer-term view during 100% normal and to be expected volatility. Volatility that will absolutely positively return sometime in the next few days, weeks, or months. It's inevitable. The recent signal and the historical study also helps us keep an open mind about worse than expected outcomes looking out 3 to 5 years, and reminds us that maximum flexibility is always important, no matter what the data looks like in the rearview mirror. When you can make an argument that stocks are overvalued and you can make an argument that bonds are overvalued, guess what matters? Relative valuations. Tweet on the left, tweet on the right. Speak to relative valuations. Been talking for a long time about less bad relative to economic data and better than expected. Not very encouraging that this week 1.2 million people filed for unemployment. That's the bad news. The good news is less bad and better than expected. That's the lowest reading since the crisis began. Transportation average. Here's a breakout, good things happen. Here's a breakout, good things happen. Trying to break out. Note, that can take a long time, and there can be a lot of fits and starts. All things being equal, this is a good look. It was rejected at the red line, and now we're above it. The longer we stay above it, the more meaningful it becomes. This is growth stocks, SCHG, in the ETF world relative to TLT, long-term treasury bonds. Recent A to B plunge that occurred in 2020, like many of the charts that we've been covering in recent weeks, the ratio has been consolidating above the 61.8% retracement. And you can make an argument that this is somewhat of a cup and handle consolidation pattern here and a bullish breakout. If market participants were extremely concerned about future economic outcomes, especially from a longer-term perspective, it's not likely that this chart would look like this. Obviously, that's subject to change, but it hasn't changed yet. Similar concepts here. March 23rd low in this general area. This is the global automobile index relative to the S&P 500. This is somewhat of a constructive look here, which also speaks to economic expectations on multiple time frames. I believe we tweeted this chart earlier in the week. Growth-oriented retail relative to defensive-oriented staples, or XRT, relative to XLP. Constructive look here. You can make an argument that this is a decline. This is a large left shoulder. This is a head. And this is a more shallow and compact right shoulder. This is the neckline. And this is a bullish breakout potentially from a bullish bottoming inverse head and shoulders pattern. Patterns, like everything else, do not speak to certainties. They speak to probabilities. Solar stocks can be volatile, and monitoring them can help us with risk appetite. TAN is the ETF. For the most part, it's been bouncing around violently for 9 years. August 6th of 2020, trying to sustain a bullish breakout. The longer a market goes sideways, the bigger the move you can expect to get. That would apply from a probability perspective if the breakout holds. Keep in mind, even if it's a successful breakout, breakouts can have scary retests that would include coming back into the orange box. Also noteworthy, from a consolidation perspective, price has basically gone absolutely positively nowhere point to point for 12 years. Telling us we could see a big move in this direction above the blue box, and if it fails, we could see a big move in this direction below the blue box. Some interesting looks here. TAN, solar stocks, relative to the S&P 500. This is 2012. This is a daily chart. This is pretty much self-explanatory. We can add in this look here. You can make an argument that this is a left shoulder, this is a head, and this is a right shoulder. And if you know market patterns, you know if your neckline is upward sloping, that tends to be even more bullish when you get a breakout. This ratio is above this blue line. It's above this neckline. It's above this trend channel. And it's above this downward sloping trend line. The longer it stays above it, the more meaningful it becomes. You can pause your video player. Turning Point Macro Research tweet, Twitter handle where my cursor is, some additional information relative to solar stocks. What did this study here tell us? It tells us that bullish momentum, especially a longer-term turn, from a probability perspective, can be followed by very satisfying returns in the stock market. Said another way, when good things happen, the odds of good things happening walking forward increase. It's the basic concept of momentum and trends. Here's another example here, LPL Research. When stocks are up in April, May, June, and July, as they have been in 2020, typically the final 5 months of the year, good things happen. 10 out of 11 cases, the market was higher. The median gain was just a hair under 10% over the final 5 months of the year. And I might add, in every single one of these cases, you could have said, there is no way the stock market can keep pushing higher because it went up in April, May, June, and July. It has to pull back soon. Only happened in one case here. 10 out of the 11 cases didn't happen. Open the video with this tweet and this question: is anyone positioned for a 5 to 10 year economic expansion? I think you can make an argument that the answer is yes, because anyone is a broad term. And it aligns nicely with our market wizards concept. Charts cannot predict the future. You have to use your own intellect to try to discern what the action of some traders, the past action of some traders, might tell us about the future action of other traders. This is a repositioning by some traders. Typically, when this repositioning happens, others follow. Thus, you can make an argument that the answer to the question, is anyone positioned for a 5 to 10 year economic expansion, is some market participants have already started to realign for a longer-term economic expansion. That's the past actions of some market participant. Who might follow? Retail investors. Retail investors remain highly skeptical. This week, optimism below 25% for the 5th time in 8 weeks. Anytime bullish sentiment has a reading below 27.9, which it does today, it is unusually low. If 23% of the respondents are bullish, it basically tells us they are not fully invested. And human psychology tells us that eventually that money tends to come off the sidelines. Eventually that money tends to come off the sidelines. But Chris, that can't be. Everybody's all in. If you pause your video player, this tweet here says everyone is not all in. And this rally in home builders here tells us that some market participants are repositioning, already have repositioned for improving odds that a 5 to 10 year economic expansion could follow the current contraction. To this tweet, we could add #demographics. Kicked off the video with this tweet in this table. In these 5 cases, the duration of the economic expansion that followed the contraction was 7.4 years. That's crazy, Chris. There's no way good things could happen for 5 to 7 years. You can make a case that some are starting to position for just that. How can that be? The second topic in the video was this S&P 500 yield chart. And it's noteworthy that this relates to the action of some market participants, the action of some market participants, and the action of some market participants that's similar to the action of some market participants in the present day. First case, 1975. Have we seen 1975 anywhere else? Yes, it appears right here on this table that we covered in the opening segment. So those who positioned early, it worked out well in the 1975 case. It also worked out well. 1982, after the low in 1982, the economy expanded for 7 years. How about this? The actions of market participants after the major low in 2009 that caused this move down to the blue line. How did that work out? In the Honda Accord case in 2009, pretty well. Had a 10-year economic expansion. In all three of these cases, we can see evidence of some market participants repositioning. And that repositioning started on March 23rd. And after the early adopters repositioned in these three cases, the skeptical market participants eventually followed, simply telling us to keep an open mind about much better than expected outcomes. And we know we don't trade historical studies. We trade the chart in front of us. The historical studies help us keep an open mind about a wide range of outcomes. And sometimes that's difficult to do. How can that be? Well, in the present day, somewhere in the neighborhood of 70 to 80% of individual investors are skeptical. And I can guarantee you, when people were going to the dealership to pick up their brand new 2009 Honda Accord, there was a lot of skeptical investors. And yet, after a move like this, a 10-year economic expansion followed. And as a result, good things happened in the stock market looking out 1 to 5 years. April 6th post this year, maximum flexibility right there. Maximum flexibility 100% of the time. That includes August of 2020. And the only way that we can do that effectively is to head into next week and every week with a flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and CHONACCO Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.